Hey everyone, welcome back to Corporate Decoder. Today, Gencor Industries Incorporated just filed their Q2 2026 10Q, and I'm seeing a big spending spree impacting profits. Quick note, this is not financial advice, just my take on public filings for educational purposes. While profits are down this quarter, a record backlog and a massive trade show investment suggest the company is betting on future growth. Alright, let's dive into what Gencor Industries Incorporated is telling us in their latest quarterly report. This is their 10Q filing, which gives us a look at their financial health for the 3 months ending the 31st of March 2026. First up, the balance sheet at the end of March 2026. Gencor had about $43.5 million in cash and cash equivalents. That is a nice jump from around $26.6 million at the end of September 2025. They also hold a significant amount in marketable securities, close to $111.7 million made up of things like stocks, bonds, and exchange traded funds. This shows they have a healthy amount of readily available money and investments. Now, let's talk about what really drives the business, sales, and profits. For the quarter ending the 31st of March 2026, Gencor brought in $33.8 million in net revenue. This is down from about $38.2 million in the same period last year. But here is an interesting flip. Even though sales are down, their gross profit margin actually improved. They went from about 29.7% last year to 31.7% this year. This means they are keeping a larger piece of each sales dollar after accounting for the direct costs of making their products. However, there is a big reason for the drop in operating income. Selling, general, and administrative expenses, or SG&A, for the quarter jumped significantly. They were about $4.2 million last year, but this year they shot up to nearly $5.8 million. The company specifically points to trade show expenses as the major driver of this increase. They spent a whopping $3.5 million on trade shows in the first quarter of 2026, compared to just about $345,000 the previous year. That is a massive, almost tenfold increase in trade show spending. This surge in expenses, despite better gross margins, led to a significant drop in operating income. It fell from about $6.5 million last year to $4.2 million this year. The company basically spent a lot more money to bring in less revenue, which is why operating income took a hit. And that trickles down to the bottom line. Net income for the quarter ended the 31st of March 2026 was about $3.8 million, down from $6.1 million in the same quarter last year. This translates to earnings per S-share of $0.26. Down from $0.42. Looking at the first 6 months of the fiscal year paints a similar picture, but with even sharper declines. Net revenue for the 6 months ending the 31st of March 2026 was about $57.4 million, a considerable drop from nearly $70 million in the prior year. Again, gross profit margins did improve, going from 28.8% to 30.4%. But the same story with SG&A expenses repeats, driven by those trade show costs. This resulted in operating income falling from about $11.1 million to $7.3 million. Ultimately, net income for the 6-month period dropped from $9.9 million to $7.3 million. This means earnings per S-share went from $0.68 down to $0.50. Now, let's touch on customer concentration for the quarter ending the 31st of March 2026. One customer accounted for about 13.3% of net revenues. For the 6-month period, no single customer made up 10% or more of their revenue. This is a good sign, as it means they are not overly reliant on any one client. Gencor mainly recognizes revenue from selling equipment. They have 2 ways they do this. Recognizing revenue over time for custom-built equipment, where they can track progress, and recognizing revenue at a point in time for most other equipment, usually when it ships. For the quarter ending the 31st of March 2026, equipment sales recognized over time were about $10.6 million, while sales recognized at a point in time were about $12.9 million. Specifically on their contract accounting, their contract assets, which represents revenue earned but not yet billed, stood at $7.6 million at the end of March 2026. This is down from about $12.2 million in September 2025. Gencor has one main business segment, manufacturing heavy machinery for the highway construction industry. Their products include asphalt pavers and plants, plus combustion and fluid heat transfer systems. They mainly sell in the United States, with Canada and other foreign countries making up smaller portions of their sales. For the quarter ending the 31st of March 2026, US sales were about $30.9 million, while Canada brought in about $2.3 million. Looking ahead, there have been a couple of significant events since the end of March. First, effective May 1, 2026, A change in control occurred where Mark G. Elliott, the company's president and chairman, acquired a majority of membership interests in a related company. Also, their chief financial officer, Eric Mellon, is retiring effective the 10th of June 2026, and Raymond Cole has been appointed as interim CFO. Now, let's hear directly from management about how they see things. They acknowledge that their business is seasonal and demand is driven by things like government funding for infrastructure, which is a big deal. The Infrastructure Investment and Jobs Act, passed in late 2021, is set to expire in September 2026. The company notes that if this bill is not reauthorized or fully funded, demand for their products could shrink. They are also concerned about the price of raw materials like steel. If they can't get these materials or pass on higher costs to customers, it could hurt their finances. They also mentioned that rising oil prices could affect demand for asphalt materials and increase freight costs. Management also highlights global economic uncertainties like inflation and geopolitical issues, which could disrupt their supply chain and increase costs. They mention that the company's operations haven't been significantly impacted by these issues yet, but it is something they are watching closely. Reviewing the quarter again, Gencor's net revenue decreased, mainly because of lower contract equipment revenues recognized over time. This was due to the timing of orders and shipments. Product engineering and development expenses slightly decreased, but that massive jump in SG&A, specifically those trade show costs, really impacted profitability. It's clear they made a strategic decision to invest heavily in showcasing their products. For the 6-month period, revenue dropped significantly, partly due to the uncertainty around the expiration of the federal infrastructure bill. On the other hand, their net other income, which includes interest and dividend income, actually increased slightly for the 6-month period, benefiting from higher interest rates and larger cash balances. Let's talk about their financial flexibility. At the end of March 2026, Gencor had a very strong balance sheet with nearly $43.5 million in cash and over $111 million in marketable securities. They have no debt. This gives them a lot of breathing room and resources to invest in their business. Interestingly, even though current revenue is down, their backlog of orders more than doubled. At the 31st of March 2026, their backlog was $60.5 million, up from $27.8 million a year earlier. This suggests strong future demand for their products, which is a positive sign going forward, especially considering the massive investment in trade shows. Their inventory levels are also something to note. At the end of March 2026, inventories were about $51.1 million, down from $53.5 million in September 2025. They also have a significant allowance for slow-moving and obsolete inventory, which is about $16.2 million. This means they are carrying a substantial amount of inventory that might not sell quickly or at full price. Now, Teresa Critical Point Management acknowledges they reported material weaknesses in their internal controls over financial reporting. These include issues with information technology controls like user access and program changes, and inadequate risk assessment processes. While they are actively working on fixing these, they can't guarantee when these weaknesses will be fully resolved. This is something investors should definitely keep an eye on. The company also points out that geopolitical issues like ongoing conflicts and economic instability can negatively impact their business. They are also subject to potential disruptions in their supply chain and increased costs due to tariffs. Just to round things out, the filing includes certifications from their executives, which is standard. They also have exhibits related to XBRL data, which is how financial information is formatted for electronic filing. And finally, the report is signed by the president and chairman of the board, Mark G. Elliott, and their interim chief financial officer, Raymond Cole. Alright, let's look at the big picture. Gencor made a huge investment in trade shows this quarter, which significantly hit their profits. However, they are seeing strong demand reflected in their doubled backlog. The fact that they increased gross margins despite lower sales shows some operational efficiency, but the persistent material weaknesses in their financial reporting controls are a notable concern. My biggest concern is whether this heavy trade show spending will translate into revenue growth that justifies the expense, especially with the uncertainty around infrastructure funding. What I am actually looking for is a sustained improvement in net income and a clear timeline for fixing those control weaknesses. Oh, and the research tools I actually use are linked in the description. They help keep this channel going, that is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.